Welcome to the deep dive. Today we are diving straight into, well, one of the most intense periods you can imagine in modern finance. We're using the shareholder letters from Fairfax Financial Holdings, written by V. Prem Watsa himself.
Yeah, and we're looking at a really volatile time, 1999, 2000, and then right into the aftermath of September 11th, 2001. It's just this incredible confluence of events.
Right. The dot-com crash, huge internal problems at Fairfax, and then 9/11.
And what makes Watts's letters from this time so unique is how candid they are. It's like this mix of admitting fault, being totally transparent financially, but also sticking to this really aggressive, contrarian investment view.
So our mission today is really to try and extract those core lessons. How did this holding company navigate both crises, one internal, one external, and, well, set itself up for that big recovery?
And you have to start with the pain, really.
Absolutely, because things got bad. For, what was it, 15 months, September 99 to December 2000, Fairfax stock was trading below its book value.
Yeah, which is just, ouch. The market's basically saying you're worth more broken up than running. The stock fell 7% in 2000 alone. Net income wasn't great.
And Watsa himself, in the letters, he just comes out and says it. He'd been too optimistic.
That honesty is something. But, the thing that kind of anchored them through all that short-term chaos was their history.
The long-term view.
Exactly. Book value per share had compounded at, an almost unbelievable 37% a year since 1985. So shareholders had this really stark choice. Weigh this 15-month nightmare against, well, a 15-year amazing track record.
Okay, that sets the stage perfectly. So let's dig into that nightmare first, the operational crisis that was dragging the stock down.
Right.
Fairfax made two big U.S. acquisitions in the late 90s, Crum & Forster, CFI, and TIG. Bought them at discounts, betting they could fix them up.
But yeah, a lot of people were looking at them and thinking, these are damaged goods.
And for a while there, the market seemed right.
Oh, absolutely. Watsa had to basically say, I was very wrong. He'd really underestimated how long that turnaround would actually take.
Especially since they bought them right in the middle of that really soft insurance market, right? Where prices were just too low.
Precisely. Premiums weren't covering the eventual claims. It was a tough environment to fix anything.
And you really see the impact in the numbers, don't you? Let's talk about those combined ratio targets.
Yeah, the targets versus reality.
Exactly. For CFI and TIG, the results were just terrible. The goals were pretty ambitious, right? Like 105, 106% for 2000.
Ambitious, but that's what they aimed for.
But what actually happened? CFI hits 124%. TIG hits 123.
Oof. Yeah.
So for anyone listening who maybe isn't deep in P&C insurance, what does that actually mean? A combined ratio of 124% in plain English.
That's a really important question. So the combined ratio, it's basically the gut check for underwriting health.
Okay.
It just adds up all your costs, claims, expenses, everything, and compares that total to the premiums you brought in.
Right.
If you hit 100%, you broke even, just on the insurance part.
Index?
But 124%. That means for every single dollar you collected in premiums, you're actually losing 24 cents just from underwriting the business.
Wow.
Yeah. That's just completely unsustainable. It really confirms those acquisitions were, well, bleeding cash fast.
So major internal bleeding. And then came the real shock, or the big cleanup. In the 2001 update, they had to book what they called embarrassing reserve deficiencies, basically admitting they hadn't put enough money aside for claims from 99 and 2000.
That's right. A huge number. $600 million, gross, to shore up those reserves.
Yeah.
$400 million for CFI, $200 million for TIG.
Ouch.
Yeah, it confirmed those soft market years had hidden some deep problems in how they priced risk. It's painful, but the way they framed it, it was about wiping the slate clean.
But even after that massive $600 million hit, they still defended buying them in the first place. How did they justify hanging onto these businesses that clearly had issues?
Well, they put it in context. They said, look, this wasn't just us. It was an industry phenomenon from that late 90s soft market.
Okay.
And crucially, they pointed back to the price they paid. Even after absorbing that huge reserve boost, the original price for CFI, about $680 million, was still way below its book value by September 2001, which was almost $960 million.
So the argument was the underlying value was still there if they could just stop the bleeding.
Exactly. If they could stabilize operations, the potential long-term value hadn't completely disappeared.
And that points to their financial strength, right? They could take that hit and still fund the fixes. What did those fixes actually involve on the ground?
It sounds like it was pretty intense. Strengthening management teams was key.
Right.
And then aggressively cutting unprofitable business lines, just getting rid of stuff that wasn't working,
Right.
and pushing hard on price increases.
Trying to get those premiums up.
Definitely.
Yeah.
By Q4 2000, even before 9/11, C&F's renewal pricing was already up nearly 12%. The message was clear. Get those combined ratios down. Below 105, ideally closer to 100.
Okay, so they spend like 2 years just wrestling these acquisitions, absorb a $600 million hit, finally start to see maybe some light at the end of the tunnel operationally.
Yeah, so just turn the corner.
And then the world changes. September 11th, 2001. Just the biggest shock imaginable for the insurance industry.
The timing was just unbelievable.
Brutal.
Brutal. Fairfax reported a massive loss, US $152 million pre-tax in Q3 2001, just directly from the World Trade Center attacks.
So they'd just taken that huge reserve hit for past mistakes, and now bam, the single biggest loss event in their history hits them.
Right. Since the company started in 85, it's hard to overstate the pressure.
It sounds absolutely devastating, but Watsa, reading the letters, he saw this catastrophe, this immense pain, almost strategically.
Yeah, it's fascinating. He saw the WTC loss estimated at, what, $30 to $50 billion across the whole industry as more than just pain. It was the catalyst.
The catalyst for.
The return of the hard market, something the industry hadn't really seen since maybe 1985.
Okay, explain the hard market dynamic. What does that mean practically?
Think basic supply and demand, but for insurance. Those massive WTC losses basically vaporized billions in capital across the industry. So, capacity shrank.
Less insurance available.
Exactly, which meant insurers could tighten up policy terms, be much pickier about who they insured, and most importantly, jack up prices dramatically.
So the very thing that caused so much pain, the huge losses, also created the conditions for much higher profitability going forward.
Precisely. It was this massive strategic opportunity born from tragedy. And this is where Fairfax, having gone through all that operational pain before 9/11,
They were actually ready for it.
they were ready.
Yeah.
Watsa points this out back in the last hard market in the 80s. Fairfax was basically one core insurance company.
Right.
By 2001, after all the acquisitions, good and bad, they had 8 operating companies spread across different regions, different lines. They were suddenly perfectly positioned to grow in this new high-priced world.
While other competitors maybe hadn't taken their medicine yet on reserves and were scrambling.
Exactly. Weaker players were caught flat-footed. Fairfax, having absorbed the pain, could now capitalize. It's kind of the ultimate reward for surviving the downturn with your capacity intact.
Okay, but that capacity, that resilience, it wasn't just about fixing the insurance operations, was it? The other side of the balance sheet played a huge role.
Oh, absolutely. The investment portfolio. Watsa describes it as being very strong, even when the insurance side was disappointing, to put it mildly.
And this is where that famous Fairfax contrarian streak really shows up.
Totally. While the insurance side was struggling, the investment team was making huge, aggressive bets against the U.S. stock market, right at the peak of the dot-com insanity.
The main bet being those S&P puts. The letters mention, what, U.S. $1.1 billion in notional value by 2001?
Yeah, a massive position.
So for listeners, what does buying that many S&P 500 puts actually mean? What's the bet?
It's basically buying insurance against a market crash. A put gives you the right to sell the S&P 500 index at a specific high price, even if the market tanks. So you profit if the market goes down significantly.
And this wasn't some small hedge. They'd already expensed $115 million just for the cost of those puts by the end of 2000.
Right. Long before the real crash bottomed out. That takes serious conviction.
Unbelievable conviction, really. Think about it. Your stock is trading below book, your core business is struggling, and you're placing this enormous bet against the entire market. How did he justify that level of risk?
Well, he was incredibly upfront about his view, just stated it bluntly in the letters. The S&P 500 high from early 2000, around 1,552. He said it likely wouldn't be seen again for 10 years.
Wow. Bold call. What was the logic?
Pretty straightforward, actually. Valuations.
Yeah.
He pointed to PE ratios being around 25 times earnings in 2000. Historically, the median was more like 15 times.
So just way too expensive. Bubble territory.
Exactly. He saw it as mathematically unsustainable. And he wasn't shy about pointing to the wreckage that was already happening in tech.
Yeah, the letters list examples, right? Like
Yeah.
AOL, Amazon, Yahoo, already down huge percentages by the end of 2000.
Down 54 to 86%. He called them likely permanent losses. The bubble had clearly burst, and Fairfax was positioned for it to get worse.
Okay, so the puts were the big offensive bet against equities. But their defensive positioning also paid off hugely, didn't it? The bond portfolio.
Oh, yeah. That was maybe the unsung hero. They were heavily invested in bonds, 93% high-quality, long-maturity bonds.
And when the dot-com bubble burst and the Fed started cutting interest rates,
Bond prices go up,
yeah.
especially long-maturity bonds. It created this incredible cushion.
So talk about a reversal. They had huge unrealized losses on bonds earlier.
Massive. At the end of 1999, it was a $1.24 billion unrealized loss on the bond portfolio.
Billion with a B.
Yeah. But as interest rates fell through 2000 and 2001, that completely flipped. By October 2001, it swung to an unrealized gain of about $250 million.
That's incredible. So the investment side wasn't just surviving, it was actively generating capital gains that helped offset the operational fires.
Exactly. It insulated the company. It shows the power of having those two engines, the insurance operations and the investment portfolio, ideally working independently, or at least not correlated.
That really seems like the core model here. Fix the operations, make contrarian macro calls on the investment side.
It is. And, speaking of discipline and how the company operated, you have to mention the personal accountability piece.
Yes, Watts' compensation.
Right. In the 2000 letter, right in the thick of the crisis, he makes this big change.
He cut his own bonus.
He eliminated it entirely. Effective 2000, he moved to a fixed salary of $600,000. No bonus. At a time when lots of CEOs were cashing in options.
That sends a powerful message.
A huge message of alignment. He basically said, look, shareholder returns are down, so my pay needs to reflect that. It's all about capital preservation in the long term.
And he didn't stop there, right? There's a dividend plan, too.
Yeah, he announced a plan for a modest dividend in 2001, like $1 or $2 per share. And he explicitly said it was another way to better align his own interests directly with shareholders, owning stock and receiving dividends alongside them.
So that focus on discipline, on accountability, it flowed through the whole company's approach to managing risk and capital.
Absolutely. Despite all the turmoil, they maintained pretty solid financial footing. They boosted their holding company cash target to over $800 million.
Which gives you a safety buffer.
A big one. And their net debt-to-equity ratio stayed pretty stable, around 35%. And importantly, their insurance subsidiaries kept their strong AMIM. Best ratings A or A. That's crucial for writing business.
And they put some hard rules in place for the future, didn't they? Showing they learned from the acquisition pain.
Oh, yeah. Very strict rules. Watts drew a line in the sand. No more significant acquisitions until the entire group's combined ratio was sustainably below 105%.
So fix the existing house first.
Exactly. Operations first. And the second rule was about protecting shareholders during deals.
Right, about issuing stock.
He said they would not issue Fairfax stock below $500 a share to buy another company. Given where the stock had been trading, that was a major commitment to avoiding dilution.
It really ties everything together. The operational discipline, the contrarian investing, the management accountability.
It does. So for you, the listener, it's like seeing a real-world case study unfold. You see the brutal honesty needed to clean up operations that $600 million hit.
Yeah.
You see the ability to look at a catastrophe like 9/11 and find the strategic opportunity within the pain, the hard market shift.
And the sheer conviction required to bet against the market mania with those puts, even when your own company is under pressure.
It's that combination. And it really gives you this rare peek inside, corporate decision-making under extreme stress.
It really does. And it leaves us with this final thought, maybe a provocative one for you to consider. Back in 2000, the market valued Fairfax as worth more dead than alive, stock below book value.
Rock bottom sentiment.
Yet, at that exact same time, the company's management was so confident in their own assessment, their own macro view, that they were deploying, notionally, over $1 billion betting on that same market to collapse further.
The ultimate contrarian stance.
So it makes you wonder, in really volatile times, is great financial management less about dodging every single quarterly loss and maybe more about having the deep conviction and critically the financial strength to make those really bold contrarian moves when everyone else is running scared or, completely caught up in euphoria?
It's a fascinating question, something to definitely mull over next time you see a company facing tough times or a market